Hello everyone, my name is Nico Simko and I'm one of the co-founders and the CEO of Clair. Today I'm super excited to be in San Francisco for another episode of HR Tech Trailblazers, and I'm very excited to welcome someone that I've looked up to for quite a few years, and that is Luke Voss. Luke was a very senior leader at both QuickBooks and Square Capital before he became CEO of Pipe. And with that, welcome to the podcast, Luke.
Thanks for having me. This should be fun.
Well, Luke, let's start with a simple question. Why did you decide to become CEO of Pipe?
It's interesting. You have like a whole history of like things that happen in your life and your career that like make you ready for a certain thing, and then timing is everything. And so the founders had raised 316 million of equity. They tried to do 25 things at once, and they decided that they needed somebody to come in that had experience in the same space. And so because I'd been at Square for 18 months, it was long enough for me to like understand how Square builds things fast. And so I'd learned a lot there, and it was a good time to move on to the next thing and try to figure out what's next. And I have a massive passion for small business, and I've been doing it for years at Intuit, at Square. Like even before that, in the distressed credit world, was like buying portfolios of loans backed by small business owners too.
I love it. Well, maybe before we talk about your background, you've said something that is inspiring to me, which is I like to give the team the authority to succeed by focusing.
Mm.
So talk a little bit about what is the focus at Pipe?
The focus at Pipe is to build embedded financial services for small business. Our mission is to empower financial freedom for small businesses through open, accessible, and unbiased products, right? The first product we focused on was capital, because that's the number one pain point for small businesses.
Right.
The number two pain point is spend management and bill pay and card spend, right? And so that's the number two thing we're going to focus on, because that's what our customers want. And so you should think about Pipe, though, not as a financial services company. You should think of us as a technology company, right? For us to get in and help software, like SaaS vertical software companies, do the hardest thing, which is the financial services, in a way that makes it seem like it's their product, right? Like Boulevard Capital, like powered by Pipe, like the nail salon owners trust that brand. And when they see an offer from Boulevard Capital, when they're in there completing their task, they're running their whole business there. They're booking their appointments, they're taking their payments, they're managing inventory. Every day they're in there, they trust that brand because it makes their life easy and it lets them spend more time with their families. And so when Pipe can come in and create a white labeled version for any trusted brand that has the software that helps these businesses manage things automatically, like that's the goal. Like it's amazing to be able to pop in and say, yeah, it takes 2 weeks, you can offer capital to your customers and solve their number one challenge. You can help a nail salon owner, like no FICO score, female, immigrant, borrow, like get a pre-approved offer for 80,000, draw the capital, open a second location, double her business. Like she never had access to the financial system before. So the mission matters a lot. That's like drinking the Kool-Aid for me at Intuit, I would say, like about mission-based leadership. Like that's the thing I learned at Intuit. I learned how to build stuff fast at Pipe or at Square. And now at Pipe, we use the best of both of those things to continue to help small businesses succeed. They're the most kind of it's the hardest population to serve, and they're the most overlooked. And so it's awesome to come to work every day to like deploy capital and help them grow their businesses. The customer videos are the best.
Yeah, I fully agree. I think one of the statistics that I like talking to the team about is that if you take all of the workforce in the United States and you remove the public sector, 80% of the US population works for a business with less than 250 employees.
Yeah.
250 employees is not that big. It's a few locations.
Right.
And so talk to me, maybe let's now start going back in time,
Sure.
way before you ended up at Pipe, and talk a little bit about, at QuickBooks, how you built, I think it was called QuickBooks Capital. I might be off there, but small business lending. Immense amount of data. You're super lucky. You have all of these customers. How was that, and how did you get such a big organization to take that on?
God, there's so many stories around this. Let me just like talk about what makes the most sense. So Alex Chris, CEO of PayPal, recruited me from Sixth Street Partners. So I was a distressed private equity guy. for a decade had spent time buying bad loans from banks, right? Like Sixth Street Partners, which is part of TPG Capital, and before that Lone Star Funds, and then before that Highland Capital Management. So these big multi-billion-dollar private equity funds, one CLO and hedge fund, but like mainly private equity funds, like buying all these assets. It's interesting, like this is timing again, right? Like right when Alex came to TPG to have ask me like, what the heck should we do? Um, it's when distress kind of dried up in the U.S. and the partner that I was reporting into moved to London. I started spending time lending money to lenders. Like one of the last deals I worked on was trying to let a firm get their first $100 million, another B2B2C, and Sixth Street actually just did a $4 billion deal with them, right? $4 billion plus, but we were trying to be the first 100 they were drawing down. So I spent so much time talking to, like Ron Suber from Prosper came in to TPG's offices too, because we were trying to fund the consumer loans in the healthcare business they were starting. We talked to On Deck and Blue Vine and Fund, like all of the kind of new tech lenders, plus all of the old school like MCA and factoring that had factoring was 50 people in a call center that had to like call Lockheed Martin and say, hey, is this invoice real? Okay, if it is, thanks for confirming. I'm going to send you this registered letter now that says you actually have to send it to me. So it's just very manual, old school, like 50 basis points or like 20 basis points of losses because it's just such a solid business, but it's not scalable from a fintech perspective. Right. So I'd seen all the old school ones. I'd seen a lot of the new ones, and I was worried about credit in many of them because like the old school ones knew credit well, but had no idea what was going on from a tech perspective. The new ones knew tech, but didn't know credit. Right. And I think that's still the case mostly across the ecosystem. So it's pretty rare to have companies that really understand the credit side and the tech side at the same time. But so like that's why it made sense for Alex to come chat to say, hey, like, based on everything you're seeing in the small business lending space with all these new, like, I guess I would call it like version 1 of fintech around lending, I asked a couple of questions. I said, Alex, like, how many customers do you have? He's like, 3+ million. Like, well, how many, because factoring's pretty easy, right, in my head. Like, well, how many invoices do they send? He said, let me get back to you. But when he came back, he said, yeah, they send $2 trillion of invoices a year.
Wow.
And the lights are going off in my head. Okay, this is crazy. You have all the customers. You have all of the data. You just need to actually execute on building a capital business that works.
Right.
And so he recruited me to do that. And so we did it. We went from 0 to 2.4 billion a year in volume over a few year period, right? Because we had all the data and we had all the customers. The problem though is the data was a mess. QuickBooks Capital, the team that we brought on, the data scientists that we brought on, had to figure the data out. Like this is a core theme across small business because the data is such a mess. Even in QuickBooks, like a lot of it is user entered garbage. I'll just say it because they enter the data like right before taxes are due and it's 3 months late or 2 months late.
Right.
And you could open a QuickBooks account now and put in $100 million of revenue in the last 12 periods and you'd have $1 billion business. And that's what it says. You have to get to validated data. So our team built this middle layer of data that took all of the 26 billion transactions on the accounting side, 26 billion transactions on the bank side, and you roll it up to say, okay, here's the monthly expenses, and here's the monthly
you needed an
deposits.
Enormous labeling team for this, I imagine.
Well, they already had 100 data scientists categorizing transactions.
Wow.
And you get to about 85% accuracy, which is good enough for risk, but it's not good enough to show insights back. Like all of these small business even Chase is trying to create a dashboard for the small businesses. They can't even figure out their own ACH data and ACH memos because it's just, you can't put 100 expense transactions in front of a customer and have 15 of them be wrong because they'll never trust the data again. Yeah. And so it's just, nobody's gotten to a place where you can actually show real insights across an entire business, like revenue and expenses. That's it. But yeah, that's what Intuit was about. So Intuit for me though, like getting there and then thinking about building that, I'd never built anything before. I was just the industry expert that Alex actually partnered me with Rania, who came from Google, like running like a part of the YouTube business, and we partnered together to build that thing. But everything I learned about leadership, I learned it Intuit. Like watching Brad Smith and Sasan and Scott Cook. Like Scott Cook has just had the most amazing leadership training engine that like Alex is now the CEO of PayPal, right? There's so many leaders that have come out to be CEOs at other places because that leadership playbook just works. It's about helping the small businesses and helping the consumers and solving their pain points. And if you always lead with that focus, then the products you build are gonna have product market fit because you're solving problems. Intuit's not great at building stuff though, right? And so that's like transitioning from Intuit to Square helped me learn actually how to set up squads in a way that are autonomous, that can like make their own decisions, like understand the pain points and just build the stuff that fixes and solves the problems. Like you have like the very different things, but you can put them together, and that's what we did at Pipe.
I love that. Well, let's talk a little bit about kind of, let's talk even deeper about the small businesses.
Yeah.
I'm a small business. I love the example of Boulevard for the nail salon.
Yeah.
And, for whatever reason, whatever use case, it'd be great if I could get access to $10,000.
Sure.
What if Pipe is not there, or QuickBooks Capital is not there, or Square Capital is not there? What do businesses typically do?
I mean, many of them don't even think to go even try to get access to capital, right? If they want to get capital to grow their business and you're a no FICO score immigrant, you don't even think you can go to the bank to try. And you probably shouldn't, because you won't have access. You're a ghost to the financial system. And so there's a whole group of people who just don't get access because they don't think they can. Then there's a whole other group of people who really need money bad and end up going to get like the payday loan, right? Or the like really nasty, like super high cost MCA type product of like the old school ISO broker thing that like there's really old school bad stuff that happened in the MCA space that like we're trying to get beyond and like show how there's a very friendly version of this product that's amazing. And I can talk more about that, but they go get stuff that's too expensive, or they just don't even try is the answer. Or they can, if they have a FICO score or like even a low FICO, like subprime, they can use their personal card, and it's in the 30s, right, from an APR perspective, right?
So it seems to me that, again, going back to this statistic, that this is an enormous portion of, the U.S., in our case, the U.S. workforce. For you, it's, of U.S. businesses.
Yeah.
It seems that you are really on the verge of democratizing capital. So there's completely I'm sure you have use cases where you're saying, underrepresented communities that typically have a harder time to reach what we can call the American dream, are now, thanks to, again, going through all the companies you've worked at, but with small business lending, you actually make it much more, equal, equal in terms of opportunities. And you drive that. What do you see? Maybe you have stories there of things that you've been able to unveil on the underwriting.
The thing that, I guess, the moment that kind of blew my mind is when at Intuit we built all these like amazing data science models where you use the 26 billion, like, well, the rolled up billions of transactions of like accounting data, bank data, consumer bureau, commercial bureau, like FICO or Vantage. You have all of the data, right? And you can create models that predict defaults and risk. And that's great. But when you think about the application for that, or the onboarding for that, you have to stop them 6 times and say, hey, first we need you to link your bank account. Second, we need you to authorize us from FICR perspective to pull your FICO. It's a soft pull, don't worry. Third, we need to like, we're gonna pull your consumer bureau and like 1,700 attributes from the consumer bureau. And like, it's every step is drop off in the funnel. Right. And so like, but all of the like V1 and some of the V2 embedded, like they all use, and some of our competitors still, even though they're in the same type of product, are still pulling FICO. It's because it's predictive, right? It helps, but it causes major drop off. So we convert 3 times better than many of our competitors because we don't ask for that stuff. And the thing that blew my mind when I got to Square, and here's the lay of the land for the space. Like Square Capital is doing $5 billion a year of this same type of product that Pipe does. It's an MCA like, so in the flow of money, you have a let me just describe that first. You have a coffee shop that has $1 million in revenue. You get 6 months of history. You can predict what the next 12 is very accurately. You can advance 100,000 of that million and then get paid back by holding 10% of every day's transaction. So you've, again, narrowed the problem to a single cash flow stream with perfect data, and you're advancing against that cash flow stream, and you're getting paid back first in line. Like, that's the risk setup that makes a difference. And that's why Square can just sell these things like all day long. You originate in the morning and sell in the afternoon, right? And like what blew my mind when I got to Square, so Square is doing $5 billion, Shopify Capital is doing $3 billion, PayPal working capital is down to I think $1.5 billion now because eBay was gone. And then you have Intuit's doing 2.4 of the cash flow based one, the harder one, that's like a harder, like more friction full funnel. Who else? Toast has one. Stripe Capital is doing about $1 billion. They're doing 1.4 trillion in payments volume and only $1 billion in lending. Like they could do a lot more. I'm like, it's just it's rounding error for them. Like they should, like when I say they should outsource it to Pipe, right? And like
Mm-hmm.
we could power like Stripe Capital for their merchants, right? Same thing with PayPal. Like I reach out to Alex, text Alex all the time, like nudging him, like, dude, like when are you gonna like outsource this to Pipe, right? Like all of these platforms, it's such a small part of their business, and it's such a
Right.
hard thing to do. But like that's the future. With there's more than 10 billion a year happening. Like I think Square was doing more than JP Morgan in the
Right.
small business space already, and now you have 10 of it happening, and all these other platforms want to do it. There's other folks like Pipe that are like creating the embeddable version and white labelable version, and so all this shift to software over time, um, banking will shift to there, and like
Right.
this product is the only one that is frictionless. And like so, back to the original statement here, I got to Square, and I'm like, where's the FICO score? Like, where's the bank data? Where's the bureau data? Like commercial consumers, like, oh, we don't use any of it. We just have machine learning models that predict the future of this cash flow stream. And like 5 billion a year in volume, 7,000 average advance size or loan size, and more than 120,000 customers a year served. And
So
it's just amazing.
you basically are saying it's not only that the funnel got better because you asked for less data,
Yeah.
but you could actually overall blend better.
You have better risk. Like one of the things, so I'm an advisor to Nico Partners, and I've
Mm-hmm.
said this before, but like Hans Morris, he was the like president at Visa and the CFO at Citi, like old school financial services guy, like investing in fintech. His main advice to me when I started was you have to get to balance sheet light. You cannot
Mm-hmm.
be a balance sheet lender and expect to scale. Like you'll always have capital as a constraint, and you'll never get the multiple you need and to grow as a
Right.
business. You have to get to balance sheet light, which means you have to be able to originate that $100,000 advance to the coffee shop in the morning. They agree to pay you back 113 over a year, and you turn around and sell that $113 receivable for 106 or 107 the same day, right? And so you're basically booking a 6-7 point gain on sale every single day for every dollar you deploy.
Right.
That's not a capital business. Like that's you're just like effectively originating the risk and giving it to the
Right.
investors who want to own that risk, and they love it because they can buy it all
Mhm.
day long and lever it up in the background and get to mid-teens yields, right?
Yeah.
And so like this is the only small business product that you can do that on, unless it's a like a securitization of a mid-market and up type
Right.
of thing. So you look at what Brex and Ramp are doing on the card side for businesses, those are not small businesses at all. Like
Oh,
the average cash in the bank account for the Brex customers and their securitizations, it's public data, is $230,000 of cash in the bank account.
wow.
That's easy to underwrite, and that's then easy to put into a conduit and then move it on in the normal commercial card space.
Mm.
This like the risk of these micro merchants, and when I say micro merchant, I mean 100,000 in revenue up to 5 million in revenue, which if you look at of the 33 million businesses in the US, it's probably 95% of them, right?
Right.
It's like 30 million plus. And so they're all like, this is the sweet spot for this core product. And it's the only product that can get to balance sheet light because the risk is so good because of that narrowing of the risk and perfect data on the cash flow stream and getting paid back first. All of these little pieces have to drop together. And it also, like in the most amazing way, gives you the most frictionless funnel. And so you have the highest conversion. It's like 3 or 4 clicks to
Right.
get the advance. No data has to be entered because we're getting the PII from the partner,
Yeah.
right? Once the customer clicks and says, I agree to have the partner share, right? Like all of these things come together to this kind of magical experience for the customer who could never get access before. But all these pieces had to come together over time. Like Square was one of the early ones to do it
Mm-hmm.
with real tech and like kind of stumbled their way into it with machine learning with no credit strategy folks. Like even when I got there, like I had to help put more portfolio management stuff into place
Right.
because the machine learning model will pick it up. And
Right.
like I can already see restaurant spend down 20% year over year. Like let's reduce the loan amount to get the vintage back in line
Right.
before the model picks it up because you
Right.
already know it's going to happen. So like you have to you have to put the right credit strategy on top of this stuff too to really make it work. But like there's just a lot of little pieces that come together to make for that magical thing. And that's
Yeah.
what Pipe Capital as a service is.
Let's talk a little bit about Boulevard for a minute, which is Boulevard has to do some form of implementation with you.
Mhm.
How should a company like Boulevard know whether they're the right partner for Pipe?
Sure. Pipe has 3 customers, right? The way I talk about it. Number 1 is the underlying small business that needs access to capital. Number 2 is the partner that,
Mm-hmm.
that is serving that small business. So the big B's and the B2B relationship. Number 3 is capital markets. I just described why capital markets loves this product, right? So they're happy. But to keep the partner happy, you have to make it low code or no code to actually do the integration. So pipe, there's really two steps. The first step is just to share an anonymized data set. Like if you have, like we just launched with House Call Pro in Canada.
Amazing.
So House Call Pro sends us a list of all of their Canadian customers with just a unique identifier. I don't even know who they are. And you get like 4 months or 6 months of transaction history. It can even be just monthly transaction, like monthly dollar amount that was came in through credit cards or through payments, and monthly count of transaction. The models are so good now that we have that you can get to pre-approved offer from just that data set, like literally 12 data points on an anonymized, like unique identifier. We can put back a unique identifier with pre-approved offer that is 100% approval for credit. The only reason why someone will get declined when they come in is if it's a fraud issue, or if it's a violation of our acceptable use policy, or if there's a mismatch on KYC, KYB, and we ask for an ID and they just don't send it in. So only 1.3% of people don't qualify once they come through, and mainly because the identity didn't match. The credit is 100% automated. There's no other product you can do that on, right? It's pretty amazing. And so with just that initial like data share, sign an NDA, like send the data over, we send back the pre-approved offers, and you immediately can size the whole thing. Like this is what your customers qualify for.
Right.
When you compare it to expected attach, like Square got to 25% attach in their base. Intuit got to 10, and then when they did pre-approved offers, got it up to like 15, maybe like a little over 15% attach, because pre-approved makes a huge difference, right?
Right.
Um,
Yeah, you can show the dollar amount,
right.
and then it's much
Yeah,
more
that nail
tangible.
salon owner sees a like an email or a banner that pops up when she's trying to pay payroll that says you are pre-approved for $80,000. Click here to take it. It's only going to take you 4 clicks, right? And so like having that pre-approved, like, really, I'm pre-approved. That means I'm going to get it. Like they'll click to see what it is, and then they land on a landing page, right? But like that first step is sizes without doing any work. We need one data scientist to pull the data, or one data analyst really to pull the data. If they're using Snowflake, we can actually integrate through Snowflake and pull the data ourselves sometimes. And so that one step shows you how big the opportunity is. 25% is perfect attach. Like I would expect to get from 15 to 20 in most of these partnerships. The SaaS verticals, you'll get to 15 to 20, and you can just size it. And we share like 25% of the revenue we make back with the partner. And so they're getting 25% of the revenue with no regulatory risk, or very low regulatory risk, and no like low credit risk at all. Like it's truly pipe capital. We take all that risk and we give back most, like 25% of the revenue, right?
Wow.
And so it's compelling for the partner because they don't have to really do anything but have a data analyst pull the stuff. And then if they say, okay, that's pretty cool, like we see how big it could be if you get to 15% or 20% conversion, let's go ahead and do a pilot. And so we'll prove to them how good our conversion is and how frictionless our funnel is. And so that next step is to do a fully pipe hosted pilot that looks exactly like the partner's like website, or like it could even be embedded in the left nav. So we can do an iframe of the hosted experience in the left nav of their product, like a capital tab, and nobody can tell that it's not that brand capital product, right? Or like from a no code perspective, like we just literally send an email campaign to the like 2 emails to the customer base. Here's your pre-approved offer. They land on Pipe's page. It looks like the partner, and then you get 5% attached with 2 emails. Like
Wow.
it's nuts in some partnerships, right? And so
Wow.
when they see that, they're like, holy wow, this is amazing. Let's go ahead and embed it now, and let's go ahead and like open it up to the entire population. And so like if we get to that pilot state, even if we're going toe to toe with our competitors, like we just convert better. We have a higher coverage, can serve more of the customers. We have a higher conversion, and we just have a more friendly product. And I can talk more about that in a minute too, but like that's the magical thing. So it's just a couple of steps with like the first to really validate the assumptions before you prioritize any engineering time. Like you can get to the pilot and have it all show like this is exactly what you should expect from a revenue perspective. Then it's easy to prioritize. And
That
so
makes sense.
it just changes things. Like that pilot is the key. It's just a no code pilot for the partner.
So let's talk about no-code pilot for the partner. You say we need the data, we just need to send in the data scientist. What is the data you need?
So if you think about that coffee shop example, if it's a coffee shop SaaS vertical and they have 10,000 coffee shops, we need 10,000 unique identifiers and really 12 data points. Each of the last 6 months of aggregate dollar volume of card coming in.
So you need point of sale
and
data.
count of transaction, right?
And count of transaction, okay.
Like think about the Square terminal in a coffee shop.
Yes.
Like that's the easiest example. Like that Square terminal is only one like it's probably 50 to 60 or 70% of the revenue coming into that coffee shop, because they may sell stuff on Shopify too, for example.
Right.
But for that 60% of revenue, you have perfect data. And so you use that perfect data, just 6 months of history, count and amount.
Right.
And then we need some chargeback data too to help for retailers. You need chargeback data, like especially e-com. If you get that, that's all you need. And then we can give you back pre-approved offer.
So basically any software provider that has all the data around the income and the revenue from a particular business is basically a candidate to just layer in pipe. And yeah.
The way to think about it is from a small business fintech perspective, there is money in, there is money out, and there is money at rest. Money in is PayFac, payment facilitator. It's Square, Stripe, like Toast has a PayFac. Slice has a PayFac. Stripe powers a lot of these from a payments perspective. We can still do Pipe Capital on top of Stripe Connect. And we've gone toe to toe with Stripe Capital a few times and won. And so it's possible to do it with whatever payment processor they have in the background. They just need that transaction level payments data. Right. Either like, and through most of those setups with the PayFac, they're either like some of the PayFac as a services are coming in as well. That are like supporting these SaaS vertical platforms. And so the money in everything I've described is the money inside. That is the ICP from a partner perspective for us. Like it's the ideal partner, IPP, whatever you call it.
Right.
Make up acronyms. Our ideal partner profile for us is that like they serve businesses that have between 100,000 and 5 million in revenue. The businesses are coming in every single day to do stuff, complete tasks, manage their business, and they accept payments because embedded payments was the first thing that got embedded. And so there's a lot of them that are out there now. And so like that is the perfect partner for us. They are taking payments.
Okay.
On that money outside, it's hard. Like you can impute based on payroll plus bill pay spend and other stuff. If you have the industry and the geography and kind of the average size, you can impute what their revenue might be, but you can't get to pre-approved offer. You can get to pre-qualified. And the difference between pre-approved and pre-qualified is pre-approved, you have to be 90% sure they're getting it. Pre-qualified is like 70% sure they're getting it. Right. And so you can get pretty close, but you're really relying on that money at the third thing, which is the money at rest, which is the bank transaction data. So with bank transaction data, you won't see the like every single transaction from that Square POS terminal. You'll see a daily ACH deposit coming in to the bank account, and you won't see the count of transaction at all. The count of transaction becomes 365 for the year because there's only 360, or really 250 because there's 250 business days where the money comes in from Square. And so the granular, like the visibility in the data is not good enough to get to pre-approved. You can still get to pre-qualified again, but it's not like the conversion is double when you show pre-approved versus pre-qual.
Yeah.
Right. And like that's everything. And so really our sweet spot is the PayFac, like our SaaS vertical that is a PayFac or has a PayFac partner is processing payments somehow.
Yeah. Okay. So assume I'm at House School Pro, I'm at Boulevard, one of your customers on the partner side.
Yeah.
And how do they need to think about launching this? Meaning, you talked about positioning of a button, you talked about emails.
Yeah.
Do you send emails? Do they? How does that work?
We have a whole like go-to-market playbook for them based on everything we learned at Intuit, everything we learned at Square. Like at Square, 30% of the volume for capital came from the balances page. So when a business does their daily sales, they know that at the end of the day, an ACH is going to be triggered. They get in there and they look. And if they really need money, they get in there and look and see how much money am I getting today and when am I going to get it. That's where instant transfer goes. And so they can instantly get the money and pay a small fee, or they can get the pre-approved offer just sits there. And so when they go back, they like when they're in that state of mind to like, I need money, like that's the point of pain to like where I need the money now. That's where to put the offer. Like that's this security blanket. Like Pipe's product is a multi-draw line of credit like thing that can just follow the customer around on the product. And so when they go to pay payroll, they can pay payroll with capital instead of their Bank of America account, right? If it's a payroll offering. If they receive an invoice and need to send the invoice, you can go ahead and pay the bill now. If they send an invoice and they're waiting to get paid, you can just give them the money now and they get and we'll hold the same way we do on every other invoice that comes in later. So like this product just works for every type of access. Look, those are just the access points, right?
Right.
Like the pay payroll and the invoice one, we're really good at Intuit. A third of traffic usually comes from email because you send like a monthly digest of like, here's the financial stuff you could be doing to improve your business. And here's a call to action to get capital now if you need it. And it's like helpful communication to the customer. They're learning something, and they're reminded again that they have this pre-approved offer out there they can take whenever they want. And so the easiest thing to do is just set up an email campaign. Like we can draft everything, all the graphics, everything, and have you send it, or we can send it through HubSpot. Like figure out how to make it work. But it depends on whether the customer really wants to control the communication. They want to outsource it to you, and what they have built already. Do they have a MarTech engine built? Most of them don't.
Right.
And so we help them with that. Depending on the sophistication of the partner, you can do it, right?
Yeah. You know, one thing, there's so many similarities between what we do at Claire and what you guys do is because we often have seen that just telling people capital is there and in a few clicks they can get access to it, just knowing it's there makes them sleep better at night.
Yeah.
And it's such a big difference into what, in our case, consumers, in your case, it's business owners,
Yeah.
are able to just do. They're able to invest in their business, like honestly run their business more efficiently. I love that.
It's so interesting because every survey, like we run all these surveys at Intuit, all these surveys at Square, and at Intuit it's the same. Like Intuit, we did on the consumer side too, and you're gonna love this one. Scott Cook was the one like at the center of this. Like, let's go find out the brand new survey to find out what the biggest customer pain points are right now.
Right.
Number one on the small business side was I sent an invoice and I have to wait to get paid. Number one on the consumer side was I worked some hours and I have to wait to get paid. Right? Like I'll just give it to you. Like, it's maybe for you, but like that's the truth of it, right?
Right.
And so like to be and then so then you run all the rest of the surveys about like, okay, capital, what do you think about capital? It's like I don't want a term loan. I don't care what it is. I just want to know that if I need the money, I can draw more like an insurance policy, that security blanket. Like they need that security blanket. And so they all think, well, maybe line of credit's the thing, as long as I don't have to pay an unused line fee. So you want to give that functionality of like, here it is, you can use it whenever you want. You can draw as much or a little as you want. You can come back tomorrow and get the rest if you
Right.
want. That's the ideal thing to give to the customer because that is what they want. They want that security blanket, just as you describe it.
Exactly.
That's it. It's almost like an insurance policy.
Exactly. Well, let's double down into the middle piece. So you're, one of the three customers you have. Which partners don't work out? Like which partners do you, when you talk to them in intro calls, you say, I think it's too early. I think you guys are not ready, or you need to complement your services with X, Y, or Z. Like what doesn't work out?
There's a size cutoff at some point, right? You want them to have at least 5,000 business customers to make it like worth our time to spend the work. Like we don't have a fully self-serve setup yet. We're working on making it self-serve where that smaller software company can come in and say, I have 1,000 customers. I'm going to go ahead and turn this on. And like we're working on that. We'd like to make it self-serve. But until we do, like 5,000 is kind of the cutoff. We need them to have at least 5K customers. The other piece is the underlying small business actually has to interact with the software, right? So there's a whole world out there of like payment processor and ISO, like an independent sales organization that is using Elevon in the background and like selling a business payments, and then like a year later says, you know what, the ISO broker, like I can make more money over here. I'm going to switch into this other processor and I'm going to convince them to move over here. All that small business ever sees, like they never see anything from the processor.
Right.
And they never see, like they may know who the ISO brand is, but they're not doing anything. They're only getting a monthly PDF statement that shows what their transactions were, right? And there's no linkage into software of any kind. Like some of them are trying to build more and the ISOs are selling more integrated offerings, but most of old school payments is that. Like some guy walking around to the retailer and said, hey, like why are you using that? You could use this fancy new terminal, but all it is a terminal. Right. Yes, it might work with your cash drawer too, but like it's not actual software to run your business. It doesn't link data back into QuickBooks. It doesn't do anything. And so like that whole space of the business owners that are not using SaaS vertical software yet or using things that actually make their life easier, if it's just old school terminal, you don't have an opportunity to convert them because they don't even know who the processor is. They don't even know who the ISO is. So they don't have, there's no chance to put the offer in. They won't even open the email because they don't even never received an email from the ISO before. Like they got set up and they're gone.
Yeah.
So there's a world like where it really works is where the underlying small business is completing tasks every single day, like booking their appointments, taking their payments, like managing their bill pay, like whatever it is, they're coming in to do something. If it's just an old school ISO, like you get 10x less conversion. Right. And so like this, even 5 years ago, there weren't the verticals yet. There were the horizontals. You had Intuit, which is, I think, a horizontal, and you have Square, which is like a retail horizontal. The first verticals were like Toast coming in and dominating restaurants. Right. And so the timing of this product only works because the ISO world is going away and vertical is winning. right? Because it makes the business's life easier, and they can automate stuff and spend more time with their kids, right? That's it. So all these little now is the time for embedded capital, right?
Right. So let's talk about embedded capital. Seems like you have two major products. One is your core one, and then the other one's the card program, which is built on top. Stop me if this is off, but what does pipe look like 2030?
Okay, it's 2025, so 5 years out.
Yeah.
I think we're going to go down the list on the embedded financial services side. We are a technology company. Capital is our wedge. Number one, like solves. I'm going to say this over and over again. It solves the number one pain point for small business. It is a high lifetime value product for us, so it actually pays our bills, and so it's our wedge, and it gets us access to data, right? Because we have these verticalized data sets, that's a massive advantage to build more stuff, right? I think the number two pain point, as we talked about, is card, and so like depending on when we start showing clips from this, we'll be announcing an acquisition in the account payable automation space. So we'll have a full spend management suite. So think like Ramp or Brex for micro merchants.
Wow.
So the 100,000 in revenue to 5 million in revenue, there is no product for them on the spend management side right now. Just like card, like especially on the card side, it doesn't work. Brex and Ramp, as we talked about earlier, do not go down market at all. They are like 50, like 25 plus million in revenue businesses with cash in the bank account to underwrite, and they stay up there. And because they don't know how to acquire the small bit, like Brex got out of this, remember? Like they shut down their small business because they couldn't acquire them, number one, and they couldn't figure out the risk. So we have this pipe capital multi-draw risk engine that can power our card. We'll have the full Ramp for micro merchant expenses, like expense management solution with AI that ingests the invoice, sucks the data out, line level management. It's going to be an amazing product. And then we're going to dial it in for the business owner that has like 5 or 10 employees for the very first time, because we have the risk engine that works for it. There's just a gap in the market. Amex and Capital One don't even serve it because they're 720 plus FICO, right? Like you just can't get access to these tools because they're dependent upon the risk, because you have to float 30 days for them to go spend. And like if you're doing that, you're going to eat it if you don't get the risk right. And I've known a bunch of platforms that have tried to launch even just charge cards for these merchants, and these can't figure it out. This risk engine will let us do it. So these pieces fit together nicely, right? We'll have really 3 products. You'll have the account payable automation, you'll have the card spend automation, you'll have capital. And they all work together because you can spend, you can use capital to pay your bills. You can like automate, like it just automates everything. It will link back into QuickBooks and automate the data. So we truly will start competing with no one, but like we'll start offering a new product for those micro merchants on the spend management side. And that's the second one.
What I love where you're going is that the way I see it is almost network effects, and let me explain where I'm going with this, but it's almost network effects in your distribution where you're taking someone, let's take, I'm going back to the nail salon. The nail salon uses Boulevard, but suddenly maybe they use, payroll system X, and you realize, well, actually now I cover 20, 30, 40% of payroll system X's, customer base. And so maybe I can partner with them. They don't necessarily need to give me all the data because I already have it in this other place. And now suddenly a provider who doesn't necessarily furnish you all the data you're super excited about, you have a disadvantage compared to them. I know many of them will try, but like try to build it on their own or like, work with someone else. So it's almost as much as you can get the land grab, you can then go where the customer is interacting, and you can actually enter, like you can own the market. It's really, really hard to remove pipe at that point.
Right. So we are building distribution through capital first. And so we have over 1 million small businesses across our partner base right now. And so those small businesses like have access to capital. They will soon have access to card and spend management. Then they're going to have access to like payroll. Like we're going to do embedded payroll. We're trying to decide whether we partner with someone who you probably partnered with, or just building it ourselves, right? We already have money in, we have money out, we have risk, we have regulatory. All we need is the withholding engine. So we can get that through an API and build payroll for ourselves. We can have an embedded payroll offering. If they've done the initial API integration on just capital, everything else should just be a flip of a switch to turn on the other products. And when it turns on the capital tab, you can also turn on the pipes, or you can turn on the whatever spend tab, and you can turn on the payroll tab, right? That's most of the spend at that point. We also have an FBO layer that lets us get in the flow of money that like gives us a bank account for the customer. And so I won't try to be the primary, like Pipe and like my team will not try to be the primary checking account because, for example, at Square, no one took Square checking unless they did not have a business checking account yet. So once they have it, they're not going to switch. But if you start with like one small feature saying, hey, we're already holding for the capital when you take advances from us. We can hold 8% more of every transaction to save for taxes for you. We could hold in another envelope or savings folder another 10% to pay your payroll. And so you have these savings folders. And so that's a secondary feature from a financial service, like a banking perspective, but people love it because it helps them keep track of what they need to spend money on later. And then you add bill pay to that, and you start spending, like you can start spending from that account, right? You could like you start routing the revenue into that account. You take on most of the then and only then may you have the right to take on the primary checking account. But we would need to build wires and all kinds of other stuff too. So we're not targeting banking, but that's a possibility.
That's a possibility.
Right? So all of embedded financial embedded financial services pipe can do.
Right.
Right. Like insurance. I've tried insurance a few times too, like maybe insurance. But if we do payroll, like of course I'll come to you to say, hey, can we do preliminary tax test too? Right.
I'll be ready when you are. But okay, so where my head is going is if you look at the history of literally banking as an industry started with these people with balance sheet who went out to lend. They then said, well, now that we're lending, we can also take deposits.
Yeah.
And now that they have that, they then expanded. But many people don't know that, but one of the first jobs that I had going out of college is I was working very closely with a team called the Treasury Services team at JP Morgan.
Yeah.
And the Treasury Services team was responsible for banking very large corporations. It's a fancy term to say your bank account.
Yeah.
And your liquidity management. But the reality is when I saw what customers were coming in, customers were not coming in for banking. They came in because they said, well, if you want us to give you that $100 million line, General Motors, General Electric, well, you're going to have to come and bank with us.
We need deposits. Yeah.
We need deposits. And so I think what's super cool is that you're removing the complexity of being your own bank. You're saying, look, at the end of the day, we're going to be there. We're going to be the technology layer because distribution is based on technology here, not capital. We're going to be able to figure that out with your background. You're going to lead with technology. You're going to come in with the thing that is most pressing, which is people are stressed out. They're going to run out of money as a small business.
Yeah.
You take them in, and then you layer on more and more stuff as you go. And then you try through technology to make their entire life easier. I buy this because I talk to all of these people every day.
Yeah.
And like they just want better solutions.
Certainly. Like I think you like have kind of hit the nail on the head. Like the whole going back to the history of banking though, like yes, they needed those deposits, but it's an investment. It's a wealth management business. They're putting you into treasuries, they're putting you into overnight swaps, trying like now you can earn 5 or more on like our cash. Like we have cash at JP Morgan, the pipe, like our treasury account and at HSBC, right? And so that money is invested on our behalf and we earn the yield on that. But like they need those deposits back. It's so interesting because we're actually starting to connect the dots across our own capital markets, right? So when we have a $200 million warehouse from a group of banks, we actually get a discount on what they charge us if we put deposits back onto those banks' balance sheets through IntraFi, right? And so we'll start getting float from our payroll business, from our bill pay business. We'll put that back into the banks that lend us the money to then do the capital. Like we're recreating all of banking, and we're not a bank. We're not even a lender, right? Like we do cash advances to businesses, but like we have the best experiences to put in front of the customer. We can route the money back to where it's needed into the traditional banking system, of course. Like they need the deposits. They then give us a warehouse to then make these advances, right? It all comes back together. It's the same business model. It's just different players in different spots making it all happen. It's so interesting.
And one thing, I mean, even as I was talking about this, one of the use cases that like over the past 2 years, so many small businesses have talked to me about, whether on my personal life, but also like at work, is this concept of tips. So if you go around the United States, tip payouts is actually a fairly complicated thing to manage for a small business because what they typically get paid 2-3 days because of credit card payments, and then but the employees more and more want their tips, if it's not weekly, they want it faster.
I work some hours and I want to get paid.
I work some hours and I get paid. But the reason why I think this is almost a pipe level discussion and less of a Clair EWA conversation is that at the end of the day, like if a small business is trying to pay out tips all the time, better electronically, directly from their bank account, there's a cash crunch because they're not going to get paid for another 3-4 days. Like I went to get a haircut yesterday, and I could see in the background that all the tips are cash tips, and they prefer cash tips, honestly, for speed of pay. So there's use cases that sound small, but represents billions and billions of dollars of transactions that with a small line of capital that is tech-enabled,
Yeah.
you can solve really quickly.
Well, it's fascinating though. Like, I think Chime is a good example.
Yeah.
Like, you know this well. Like, Chime created like 2-day early pay
Yes.
without having to float. Like, they have to float some of the cash, but the risk is super low, right? Because you see the ACH file come in, you know it's going to settle 2 days from now, and the money's coming in from JP Morgan or somebody else, like that bank, and it's not going to return because the payer is a massive company that's paying through ADP or something. So you know the money's coming in. It's McDonald's paying a paycheck, for example.
Right.
You can just basically like arbitrage the ACH 2-day delay and release the money faster without taking much risk. So yes, it may take some float, but the risk is super low if you do the risk part right. If you then want to advance like like an advance ahead of time before they've even worked the hours, there's way more risk in that. It's
More
a totally
risk.
different product. If you've seen them work the hours and you know they're going to get paid them, the risk is lower. But like,
Yeah.
I think that you're right. There's float that's needed, but if you manage the risk the right way, you can get the money you need to do that and make the business happen. Or you build it like Pipe is building it, where we're actually generating float in other parts of our business that can be used to make like to do that stuff and make stuff happen, right?
Exactly.
You generate
Exactly.
your own float, like payroll, like most of the revenue comes from float,
Afloat. Yeah.
right? And so same thing in bill pay. There's so many dollars that are there that you can earn money on and use those or give them to a bank that has the right to use those deposits to lever them up and lend them out, and they'll pay you for those and then give you credit on
Right.
other stuff.
Right.
So like all these little pieces can fit together the right way.
Exactly. I love where you're going with this. Let's maybe actually like pause. Is there anything you think that we should go into that you're excited to talk about?
I think like I mentioned it earlier, like there's an old school bad version like MCA that Pipe is just not, right? And
Yes.
so when you think about like I want to make the point that Pipe is better than a term loan and better than a line of credit,
Okay.
right? And so Pipe Capital, we're advancing. Go back to that coffee shop example. The
Yeah.
coffee shop's going to make $1 million. If we do this and we advance them 100,000 and we get paid back by holding 10% of every day's transaction,
Uh-huh.
that coffee shop may have like a really slow month or a really like maybe construction
Yeah.
happens next door and like people get blocked from coming in and you can't park anymore and your business is slower. They will just pay us less because we're only holding 10% of whatever they're collecting. So if instead of $1 million they collect next year, they get 500,000, then we'll only hold 50 and we'll only get paid back half and it'll take 2 years to pay us back. But
Okay.
that's okay.
Let me
Like
ask you
it's
again that, and
yeah,
let's talk about it. So one of the things that you talked about is that this is so much better than typical term loans that these small businesses can get. Can you explain, again, I'm a nail salon, right?
yeah,
Anywhere in the United States,
sure.
how is a pipe loan going to be so much better with the business cycle you go through?
Sure. So here's a way to think about it. If you get a term loan, you'll have 12 equal payments over the next 12 months. And if you have zero revenue in one of those months, you still have to pay that payment, right? There is no relief valve. You will be late on that payment. There's nothing you can do about it. Like you have to go call them and say, hey, I can't make the payment. What do you want me to do? With the Pipe Capital product, if you have half the revenue, so if like let's just use coffee shop as example, coffee shop $1 million expected revenue. If they only have 500,000 for the next 2 years, instead of paying you back in 1 year, they're going to pay you back in two,
Hmm.
and that's just built into the product. It's
Right.
okay. And so when you like roll that up to 1,000 coffee shops, and you have this portfolio of coffee shops, each one has like we have underwriting models that can predict pretty accurately what we think it's gonna happen,
Hmm.
but in reality, half of people pay you back slower and they get automatic relief. And that's way better than a term loan. Half of people pay you back faster. And with all of our competitors, with Stripe, with Toast, with Shopify, with PayPal, all of them, if you pay back really fast, the annual cost of that capital can go through the roof, right? And so Pipe is very unique in that we refund enough of the fee to keep the annual cost down below whatever cutoff our partners want, right? And so when you add that cap, and you have automatic relief on slow, you have a cap on fast, and it feels like a line of credit that you can draw whenever you want. Like, but you're required to pay it down. Like each draw, you're required to pay down, so it's safer than revolving. So better than term loan and better than line of credit, because with a credit card, you may pay 5% a month and never pay it down, and you're paying APR forever. Like this is why
Forever. Yeah.
Max Levchin hates credit cards,
Right.
right? And so our product, each draw is going to have a natural amortization that keeps you out of trouble from just revolving and paying interest all the time, right? So it's
Mm.
better than term loan, better than line of credit. and because it's an automatic underwrite, everything I described before, like there's just no better product than this. We should be able to also take it up market and have 2-year term, 3-year term, and like hold 5% or have less fees, like 5% fees, like even lower fees, and make it just a super cheap version of the same thing. Like really all we're talking about is the payment mechanism,
Right.
right? Like holding to pay back, right? And then how you charge the fee and whether you refund it or not. Like when you start to disaggregate all these loan features or advanced features into the thing the customer wants, like that's why I love fintech the most. You could just create this thing that
Right.
is exactly what the customer wants, right?
Right. Right. Exactly. I was just listening, to the founding story of Revolut. And this idea that like fintechs, because they start with not with the fin side of things, but they typically start with the tech side of things, and then naturally get pulled into for regulatory compliance and other
Yeah.
reasons into the fin. They'll start with what's the pain point and how do we make it simple, and
Right.
then okay, if there's any really big rules we need to get from a compliance perspective, we'll implement them, but we'll start with the
Right.
user experience.
I actually just listened to the same thing on Nubank, which is on the Crucible podcast, and very great story too. Like going into a bank in Brazil, taking 5 months to open a bank account. Like,
Yes.
can't we fix that problem? Like,
Yes.
yes, we can.
It's fascinating. My wife's Brazilian, and it's like
Yeah,
the story is of financial services there is absolutely fascinating.
right. We're seeing that in some of the countries we're going into. Like Pipe is live right now in the US, the UK, and Canada. We're about to launch in Australia. Australia is a super interesting market because there's 5 banks that dominate, and the products that are available to the micro merchant businesses are super expensive. Like nobody has gone in with a friendly product that actually can serve these customers yet. And so we go in, and some of the partners are like, oh, we get paid a lot from these like more than that
Right.
from these partners. Like, yeah, it's because they're charging them 90% APRs. Like that's crazy. Like let us do one at the low 20s and make it work better and still pay you 25%, and you'll get 3 times the attach because it's a friendly product. And like once they understand that like how it's going to work, like it's going to change how small businesses access capital in Australia.
I can 100% see that. Well, I have uh, one little story. I'll ask you a question, which is when I started Claire a few years ago now, you were one of the very few people that I had met who really believed that EWA was going to be seen as a form of credit. Basically, no player thought that. Like, or very few, let's put it that way. I think those that were started as corporate-based solutions, where there was like publicly traded companies, were starting to see it from that angle. Um, uh, you know, how did you have that insight?
So one of the things that like I've used in my career, I learned actually at Sixth Street Partners. It's a bunch of ex-Goldman folks, and there's a super smart GC there named David Stiepelman. And every deal we looked at, like you wanted to make sure that there was no edge case regulatory risk that would mess anything up. And it would like this, the comment that he gave me one time, and in one of the deals we're looking at, is like life is too short to take that edge case risk. Yes, the probability of it happening is very low, but if it hits, it could be catastrophic, right? Because like maybe you some examples are like if you originate a loan the wrong way in New Jersey, it is void. Like if you originate
Mm,
the wrong way from a regulatory perspective, the customer doesn't have to pay it back, so it's a zero. And so yes, you do all this work to underwrite the risk of whether they're going to pay you back or not. But if you have this edge case risk of zero because the originator that you're buying these bad loans from screwed something up, it means none of the customers pay you back. It's not
mhm.
credit risk anymore; it's regulatory risk. And so with that mindset, when I was at Intuit at the time, and we were trying to figure out how to build an early wage access product for the 16 million payroll workers that we paid.
Right.
Right, we were number 2 behind ADP. ADP like is enterprise focused, thousands of employees at each company. Intuit was like 5 to 10 employees, and most of like 80% of them had less than 10 employees, and they paid 16 million workers. And so like that, we were trying to figure out, okay, what do we do? We also had like just bought Credit Karma, trying to think about it, and we look at it and we're like, okay, you could try to set it up to where it's not credit because the business is paying something, or you're only making money on the debit interchange, but you can't really monetize it that way. So like, how can we really do this in a bulletproof way? The answer was to just make it a super low cost actual consumer loan, right? And if you have a small enough fee, even like $5, or like I think if it's less than $7.50 of finance charge, you don't have to disclose APR.
Yeah.
And so it's an easy way for them to understand. It's like, look, it's like an ATM fee. You can draw it, and you can just take the money whenever you want. And then it actually gives you the flexibility to not have to wait for them to work the hours. You can then start to predict how many hours they're going to work next week, and then make it a real credit product. It actually gives you a window into creating real consumer credit after that. And so for all of those reasons, I was like, yeah, you could try to set it up to where it's not credit and there's real edge case risk, but if you want to just like accelerate, like take the regulatory and compliance pain now, get a bank partner. We used web bank at Intuit, right? Like get a bank partner, make it work. Then you can actually just step on the gas and really scale later.
Right.
And you'll never have that thing over like that overhang where you have to pivot and change and shift. And if you have enough capital to do it, like I'd say go do it. If you don't and you need to be more scrappy, then like maybe you can take a little more business risk, but like I just don't think like life's too short, right? If you have the capital to do it right.
I agree, and I think as a Swiss, that's a little bit the strategy that we took.
That's great.
But
It gives you an advantage now when you go into an enterprise partner and they say, "How is this structured from a legal perspective?" You say it's a loan and we have a bank issuing it. It's easy. And they're like,
Exactly.
"Okay, that's great. There's no edge case risk. I'll do that."
Exactly.
But if you came in and said, "Well, there's a 5% chance that the CFPB is going to tell me that it's a loan."
Well, now they did.
Well, they did. True, but now the CFPB is, I don't know what it is anymore. Well, that's a whole other conversation. There may be 5 people left there. But like you get to a place where like a lot of the bigger companies won't take that edge case risk, right?
Right.
They just won't. And so
Yeah.
it should be an easier partnership.
Okay. Well, last question. Something that's inspiring about your story is you're doing all of this, jumping in, being CEO of a company, and you have a lot of time for your kids and your father at home. How do you do it?
It is like you think about like focus and narrowing and prioritizing. Like all I have time for is pipe and my kids. Like I do not have time for me. Like I quit playing soccer after my second kid was born. The only way I got exercise when I was working for like TPG or Sixth Street was I turned my commute into the exercise because it would take me 45 minutes to drive home if I drove into work that morning, but it'd only take me an hour to ride my bike. And so it's worth 15 extra minutes for me to get 2 hours of cardio because I was up before the kids like, even woke up. So I have 4 kids. Let's just lay this out. Four
Right.
kids. When I was at Sixth Street, I had a 4-year-old, a 2-year-old, and a newborn. Up at 6 in the office at 6 a.m. Home, my wife, like on the way home, my wife would say, like, "What time are you gonna get here? I'll keep the kids up so you can say hi to them today." Like
Wow.
that's how bad that was, right? But I still was able to like get that 2 hours of cardio in, like riding back and forth in the dark because it was my commute time that I was taking. And so you end up with this ruthless prioritization for stuff. And now I have 3 kids playing competitive soccer. My girls are both playing on 2 basketball teams too. One of them's a horseback rider, the other one does ballet. My son's on the Redwood mountain biking team. I am a volunteer coach for that Redwood mountain biking team. And I tow the trailer to the races because none of these Marin dads know how to tow a trailer. And I grew up in Texas on a ranch. And so like the trailer is easy for me, but like you just do all this prioritization. And like now when I exercise, we're fully remote, right? So
Uh-huh.
that's a major part of this. The fact that I'm in the office, like at home all day, like I get my kids ready for school. When they go at 8, I can actually get on my like bike in my, I have a Zwift kicker bike or a Wahoo kicker bike with the Zwift set up in my office. And from 8 to 9 every day, I'm on the bike,
Right.
but I have Slack and email up. And so I can instantly respond to folks and like make sure I'm not blocking, but still get some cardio done. Like you have to multitask is the
Right.
answer. And then at the end of the day, I actually like have a sacred like 2 hours every day, unless there's a super important meeting, like from 5 to 7 where I can eat dinner and help with homework and do that stuff. But then I'm like, the other thing is like I'm just always on my device. Like
Right.
that's the one negative here. Like I have it. I'm always at work.
Yes.
Even when all this other stuff is happening, like driving kids to sports games and picking them up, like I'm still like checking stuff as I go. But you can make it work is the answer. But you have to just be ruthless with prioritization. Like I'll never play golf again,
Yes.
right? Like I signed up for one bike race just to have my one thing. Like
Right.
it's April 19th, like Levi Grand Fondo. I'm gonna go do that. And
Mhm.
it's gonna motivate me to ride more and stay in shape because I perform better as a leader when I get a ton of cardio. It's like
Right.
all these little things you can do, but like there's just no time for me anymore.
Well, I love that, Luke, and I think like maybe we'll close where we started, which is you've figured out a way to make yourself have an opportunity to succeed here on doing both. I think you bring that to the company. So again, thank you so much for doing this. I know you have a busy schedule, so really appreciate it.
No, it's always fun to have these conversations and tell these stories. So thanks for having me on.